Welcome to TIAA Simplified with Greg Shepard from SNA Financial Services. In this podcast, we help higher ed professionals overcome the confusion and frustration around managing their TIAA retirement accounts. We do this by breaking down complex rules, hidden risks, and smart strategies into clear, actionable insights. Join us for this journey where we explore how to retire smarter by truly understanding your TIAA plan, as Greg draws from years of experience and guest experts who will help you take control of your financial future with confidence. Now, on to the show.
Welcome back to TIAA Simplified, where you are encouraged to ask questions. It may have seemed so easy when you initially chose your TIAA options, but now with retirement getting closer, your head is spinning. Well, Greg Shepard understands. He is here to gently demystify the enigma that is TIAA Traditional. Greg, how do you like that, huh? Gently demystify the enigma?
Gently demystify the enigma that is TIAA Traditional. I like it. I'm going to steal that, actually.
All right. You're welcome to it. But that's exactly what you're trying to do here.
Yeah.
And you're going to start out by going back to the different contract types, correct? In TIAA
Yeah, and I tell you what. Yeah. I might throw us a little curveball here, not in a bad way by any means, but when we're talking about TIAA Traditional and the contracts they're in that Traditional lives in, a lot of times I get questions coming across my desk or my phone, so to speak, is when I know the contracts that I have Traditional in, what questions do I need to ask TIAA or internalize myself? What questions do I need to internalize myself and ask myself to accomplish what I'm trying to accomplish with Traditional and maybe lifetime income? I know that's a little convoluted, but Patrice, I have some questions here that I think a lot of folks can get a lot of use out of by either, again, asking themselves the questions or additionally ask TIAA the questions. Of course, you can ask me as well, which will have my contact information towards the end of this recording. Does that sound, are we okay with that, Patrice, in this direction?
Sounds great to me.
Okay, so again, what I've done here is I've written down 3 or 4 different questions that folks have come to me with, okay? And I just, of course, will turn around and throw them out to the public at large as to who wants to use them. Okay, so number 1, like the question I get a lot is, what key action should I take 10 years before retirement? Now, I kind of specified this because I get a lot of questions coming my way saying, okay, I have TIAA Traditional in certain contracts. What do I need to do prior to retirement to take advantage or optimize that TIAA Traditional if I do or do not want lifetime income? So I just specified it and said, hey, you all out there listening to this or watching and listening, you need to start preparing 10 years down the road, 10 years prior to retirement. The reason I say that is that I know easier said than done, because a lot of folks that are 10 years out of retirement, they're not necessarily going to really sit down, pen to paper, and hammer out a retirement plan because you have another decade left. But I tell you what, TIAA Traditional is a different animal where you do have to prepare. Okay, so you have to do just that, prepare. The reason I say that is because TIAA Traditional in some contracts can and will be illiquid. So, and you can make that can be to your advantage or not, depending upon what you want to do. And that's why you got to prepare 10 years down the road prior to retirement, because if you don't want lifetime income and you're sitting in that RA contract with a lot of money in Traditional, you can start unwinding that liquidation process 10 years prior to your exit date, to your separation of service. Okay, a lot of folks don't realize that until it's too late, so to speak. They're almost forced into lifetime income because at that time, that makes the most sense. Okay, but I'm telling everybody out there, 10 years prior to retirement, or around there, is really when you need to start putting together this retirement plan.
If you aren't thinking 10 years ahead, is there a drop dead time when you're really screwed?
Screwed, no, but you're not going to get the best or the most, how are we going to word this, the most out of your retirement because you'll be I use the word forced. I don't want to be too dramatic. You can still do some of these strategies, but again, it's not the most advantageous for your situation. I know it's kind of vague, and I understand that, but I tell you what, folks that are listening to this that have already gone through it know exactly what I'm talking about. And those that have no idea what I'm talking about, you better listen up and you better take action, whether that means contacting me or Tia, and really prepare, because you won't be screwed, but you just won't get the most out of your retirement. Okay. And that kind of leads me to the second question, if I may. A big question, a question asked various ways is, and feel free to ask your Tia wealth manager, same question here. How should I rebalance my portfolio as I approach retirement?
That's fair.
Fair, right? And I tell you what, the lazy answer to that you'll get 9 times out of 10 from folks in my space is that, yeah, as you get closer to retirement, you're going to conservatize, if that's a word, conservatize your portfolio. And again, I'll use the word fair. It's a fair answer. It's a fair statement. I'll go a little deeper. Okay. Now, we don't have time to get into all the nuances here, but what I do, and folks, this is my opinion, it's not investment advice. Do not construe it as such. You all know the drill out there. Okay. Everyone's unique. This is my opinion and how I approach it. Okay. So, how should I rebalance my portfolio as I get closer to retirement? What I want to do, if I'm in your shoes, so to speak, and I'm close on the precipice of retirement, not even 10 years, but 5 years or thereabouts, how much money do I need? First, how much money do I need to live in retirement, both on fixed expenses and then discretionary as well? And then how do I formulate a game plan in order to accomplish that monetary goal? So first, I want to figure out how much money do I need out of let's choose $1 million. Okay, simple math. How much of that $1 million do I need to provide that fixed part of my income when I retire? Accomplish 2 different ways, maybe. First, lifetime income. If I so desire, if I want lifetime income, where does that fit in my game plan? And then the liquid assets, typically invested in income producing things. Okay, in my case, we go over to Charles Schwab and invest, for the most part, it's going to be pre-tax money, so rollover IRAs, and extract from that rollover IRA income producing things. Let's say I need $60,000 in fixed income. Fixed income meaning that's going to provide for my expenses and some of my discretionary monies. Okay. So we could take a portion of that $1 million to, I'm not going to use the word guarantee, but account for those fixed expenses in 2 different ways, lifetime income and the monies over, in my case, over at Charles Schwab. The rest of the money, let's say it took $700,000 to do that. We split it up for simple math here. $350,000 lifetime income, $350,000 over at Schwab rollover IRA. Now that $60,000 is taken care of without touching principal, by the way, without touching principal on the Schwab rollover IRA. Then the rest of that money, I can't remember the dollar amount we used, the $200,000 and some odd that's left over from that $1 million. We can do whatever we want with it. We can invest in Bitcoin if we want to, tongue in cheek, but we don't need that money to produce the amount of income we need to live monetarily at retirement. Okay, I know those are a lot of words there, Patrice, but the simple answer, and what you'll get a lot, is as I get closer to retirement, yes, I want to conservatize that account. But you have to drill in more. What does that mean? What does that mean? Okay, you don't get a great / straight answer from a lot of folks in my space. Does that make sense, Patrice?
It does.
Hopefully.
It does. And one other note, when you are thinking about those expenses, those fixed expenses that you're going to have, you got to be honest with yourself. Don't think you're going to scrimp and cut back on things. You're not. In retirement, what do they say? Every day is Saturday?
The truth comes out. Yeah. And what I always do with folks is they'll tell me, we'll call it a budget.
Yes.
At retirement. And I just say, okay, great. Your budget's X. Let's tack on 10 to 15, 20%.
Right.
Because those first 10 years, typically, depending upon when you retire, of course, but typically those first 10 years, you're going to spend money for obvious reasons. You're going to travel. I got clients buying cars that they would otherwise buy, just various things that you want to splurge on. And you have the right to do so. You have the right to be selfish in that regard. But we have to take that into account. So, Patrice, you hit the nail right on the head that every day is Saturday, and you're going to spend as such typically as well. So,
yeah. Okay.
All right. You want me to go on to the next question?
Question 3.
Yeah, question 3 again. This is, again, remember, as you're listening, these are questions I want you to pose to the TIAA Wealth Manager, or again, internalize yourself. What common mistakes do people make in this stage of planning? Now, what I mean by that is what mistakes do a lot of folks make when trying to formulate the game plan either 5, 10 years prior to retirement? Very simple. The common mistake is doing nothing. I can't, literally kicking the can down the road until you're 30 days, a month, a year from retirement, and you're contacting me to try to figure this out. We're trying to increase the pace as to which we should have done years ago. So, common mistake that people make in this stage is really A, doing nothing. B, is annuitizing too much. So you're going to call TIAA. You might talk to somebody else in my space. And the easiest thing to do is to annuitize more than you should, okay, for lifetime income, because the numbers look really good. And TIAA has the word guarantee, promise associated with these payments, which they're very, very good at doing. Okay, I will certainly give them credit in that regard. And I think we're going to do I'm going to throw this in the back of my head, another episode on what lifetime income is. What I mean by that is it's not make sure I word this correctly. It's not a return on your money. It's a return of your money. They're two different things. So we need to specify and understand what that means before we fully commit to that source of income. Okay, so I think the two most common mistakes is A, the simple doing nothing. That is by far and away the biggest mistake. Okay, and then B, the second mistake, annuitizing too much because it sounds and looks pretty good, monetarily speaking, but there's other ways to accomplish what you're trying to accomplish.
Question number 4.
Number 4. What I wrote down here is, how can I model future income needs and healthcare costs? Now,
that's a good question.
It's a good question. So this goes back to the budgeting part of this conversation that we're having.
That ugly word, budgeting.
Yeah. And a lot of folks, it's like a bad word. They just don't want to do it. But you have to. Again, you have to take the onus. You have to take the ownership of your retirement. There's only, folks like me and TIAA, we can be stewards of your retirement plan and give you strategies and all that fun stuff. But you have to determine how much money you need, and only you can do that. I've had folks ask me, well, isn't there software out there that I could use? I suppose there is, but folks, it's not that hard. Just go back on your bank statement, your credit card, and take 30 minutes on a weekend and maybe an hour, and just see the last 12 months. How much money did you spend? Do you have a mortgage falling off the payment list in retirement? Okay, it's not really as difficult as one may think. Now, the reason I wrote this question down is because I do get it a lot. How can I model future income needs and healthcare costs? Now, healthcare costs are going to vary, folks. I mean, when you retire, you separate service, a lot of folks are going to come off that group plan that they have with their institution. So they're going to retire. They might have Medicare, 65. Some folks retire before that, so they're going to have private insurance, maybe on the ACA. So it varies, okay? Now, when you get to Medicare, you can kind of budget what your healthcare costs are going to be. But modeling future income is as simple as creating a budget. And you don't have to, you engineers out there, I know you like to hone it down and, get it finite to the penny. You don't have to, okay? Because it's going to change. It's a moving variable as we go through life, okay? But you have to get a pretty good idea of how much money you spend per month, per year, because that's where the strategy starts. I know it sounds simple, but a lot of folks just skip over that process, and you can't. You've got to start with how much money do I spend? Okay.
What about inflation?
Inflation. Great topic for a different episode,
Okay.
right? Good answer, huh?
Good
Inflation.
answer.
So, oh man, where do I start? So, inflation is going to be a problem when you annuitize. Okay. So, lifetime income, the fixed lifetime income does not account for inflation. And we'll get into this in a different episode, Patrice, I promise. They can kick in the variable side to combat inflation, but I'm not a fan of kicking in on the TIAA platform the variable monies into lifetime income, only the fixed, only the traditional. Okay. But it does not account for inflation. All right. They do give you these bump ups. We'll call them raises every now and again, about every other year. Probably don't take my word for this. Going off memory here, maybe smooth average per year, about 0.5% thereabouts raise per year. I'll call it a raise, but it's actually, and it doesn't happen every year. Okay. It's kind of sporadic depending upon market conditions, economic conditions. It's a TIAA's discretion as to when and what years they provide that, but it will not account for inflation. So we've got to be careful in that regard when we're annuitizing the lifetime income. So that's why we like these the liquid assets. In my case, over at Charles Schwab's rollover IRA for pre-tax money, because remember how I said we can carve off a portion of that whatever $700,000 sitting over at Schwab to account for the income part of the portfolio for the clients, okay, for the client.
Mm-hmm.
And then the rest of the money we can invest in whatever, S&P, tech, healthcare, whatever the cost or whatever the case is. And that sliver of the portfolio will account for inflation over time. Okay. History is on my side that we can accomplish it that way. All right. So again, a rather vague answer to the question about inflation. I'm going to throw it in the back of my head. We're going to do a different episode on that one.
All right, Greg. Now you had a fifth question, right?
I got a fifth question, and this is, I'll just pose it this way. So this question I get asked various ways. How do I determine my annuitization strategy? Again, I want those folks out there that are listening and watching. This is a question I want you to pose to your TIAA wealth manager. Again, the question is, how do I determine my annuitization strategy? Now, I'll take a step back and say, well, see questions 1 through 4, right? I just went over them. But it's going to be more detailed. There's no one size fits all. But literally what I want everybody to do is pause right now, go back and listen to this episode again, okay? And that will sum up and help answer that question of how do I determine my annuitization strategy? Because you've got to start with a budget. How much money do I want? Okay, how much need/want? And then, Patrice, something I didn't get into, again, we'll get into it later episodes, is if lifetime income is a part of your future, from which contracts would I start to initiate lifetime income? Because folks out there listening are going to have a myriad of contracts of which TIAA Traditional lives in. So which contracts do I start to initiate lifetime income, or does it matter? The answer is yes, it does matter. You're going to want to start with the illiquid contracts first, typically an RA contract. Okay. And Patrice, while I have something, wrestling around in my head, there's something I failed to mention. Maybe it was question number 1. Okay. Yeah. Question number 1. Let's go back. Okay. Let's go back in time a little bit. The question that I posed at the beginning of this episode is, what key action should I take 10 years prior to retirement?
Right.
I'm gonna go even deeper than that. What actions? I tell you what, this question or this topic is really for those that are out there if they're out there in their 20s and 30s. Okay, listen up. If you're a youngin' out there, 20s and 30s years of age, what should you be doing now to prepare on TIAA's platform for retirement? Okay, now you're going to put away as much money as you can for retirement, but here's something that I've been told from those that are older on the precipice of retirement, they wish they would have done when they were in their 20s and 30s, is not put too much into TIAA Traditional. Okay? Now, TIAA Traditional, when you first start, 20s and 30s, it sounds great. It's a guaranteed account. It's getting 4 whatever percent. You can't lose money unless TIAA goes bankrupt, which isn't going to happen. And it sounds great. So, 2 sides of the coin here. Yes, it's a good account for that conservative sleeve of the portfolio. But time and time again, folks reach out to me, and they're not necessarily clients. We're just chatting about their situation. and they say, hey, I wish I would have caught me. I wish they would have caught me, years down, prior to when they did, and learned that TIAA Traditional is great, but they have too much in it. And the opportunity cost is they could have put that money in the stock market, okay, various ways in the stock market, and proofs, history is on my side that you'll make more over the course of time in the stock market than you will in TIAA Traditional fixed, getting, around that 4% mark. All right.
But again, like you said, it's a comforting words to read and say, oh, I'm going to put my money here because it's safe. But in your 20s and 30s, you've got the chance.
Yeah. And no fault of their own at that age. What they did is they went down the hall and asked, Joe, Bob, Mary, Sue, what they're doing. And they say, yeah, they have this account called TIAA Traditional, and, put money in there. It's going to be there when you retire, and you don't have to worry about the stock market. And sounds great. And folks put 80% of their contributions into that and ignore it for 20 years or 30 years. Then they look back and, yeah, they have money there, but the opportunity cost is sacrificing what could have been if you had done something just at a simple S&P 500 index fund, okay, on TIAA's platform, of which they do have. So I want to bring that to light here before we wrap up here, because I was thinking about that and I failed to mention that at the beginning.
Well, I've got to say that just about everything you've covered here, you've also covered sometimes in more depth in previous episodes. So everybody should go back and listen from episode 1 on. This is a great wrap up, but you've gone into depth a little bit more in the other episodes on certain topics. And it sounds to me like we've got some good stuff coming up too.
Absolutely.
Inflation is one.
We'll get it. Everyone's favorite topic, inflation.
Yeah.
That's a fun one.
All right. Well, Greg, is there anything we haven't discussed here that you feel we should?
Oh, gosh. Oh, what
besides everything in the fate of the world, I know, but
hey, for this episode, we're going to wrap it up here. But there's many more topics, issues that we're going to tackle in future episodes for sure.
And how can people reach you? I know the information will be in the show notes, but let's hear it from your.
Yeah, very simple. Email is the best way to get a hold of me. Greg@shepardfinancial.com. Phone number 913-521-2381. Website safinancialservices.com.
All right. As I said at the beginning, folks, you are encouraged to ask questions. This is the man to ask the questions of. So get your answers from Greg. And like and follow this podcast too, so you're not going to miss any new episodes that come out. Go back and see the other episodes too. There's information in there that you can probably use, and you could probably share with some other people too. I'm Patrice Sikora, and thanks for being with us.
Thank you for listening to TIAA Simplified. Click the follow button to be notified when new episodes become available. Visit our website at www.safinancialservices.com or give us a call at 913-521-2381. And don't forget to click the follow button so you never miss an episode. S&A Financial Services, Inc. is a registered investment advisor. Content presented is for informational purposes only and should not be considered as investment advice or as an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Always consult with your tax advisor or attorney regarding your specific situation.